Good evening, everyone, and welcome to the Q3 and 9 months financial 25 earnings conference call of TCI Express. Thank you for taking the time to join us today. Our earnings presentation has been shared on the website and stock exchanges, and I hope you had a chance to go through it. I will begin by providing an overview of our business performance and key developments, followed by our CFO, Mr. Mukti, who will further elaborate on the financial performance for Q3 and 9 months, financial year 25. During the quarter, we continue to demonstrate operational resilience and strategic adaptability in a dynamic market environment. The logistics sector faced challenges due to moderation in manufacturing activity, evolving demand trends, and seasonal factors. India's manufacturing PMI softened slightly in the later months, reflecting slower production levels. The festive season demand in October was lower than expected, while November and December saw a marginal slowdown, impacting overall freight movement. Inflationary factors, including annual toll revisions of 8 to 10% and increased labor and transport costs, added pressure on operating expenses. Amidst the challenges, we remain focused on operational efficiencies, network expansion, and automation, allowing us to maintain stable business performance. In the Air Express segment, we are strengthening our metro city delivery network and have launched direct delivery services to improve service levels and customer reach. The contribution from multimodal services is steadily increasing, and we are planning to achieve 20 to 22% revenue share from multimodal logistics in the next 2 to 3 years. During 9 months 25, we incurred a capex of 20 crores, including 9.38 crores in Q3 25, primarily directed towards expanding our branch network, constructing sorting centers, and ramping up IT infrastructure. Our debt-free balance sheet and disciplined financial management has resulted in strong cash flow generation, with 40 crores cash flow from operations during the period. Furthering our commitment to shareholder value, the board has recommended an interim dividend of rupees 3 per share, reinforcing our confidence in the company's financial stability and growth prospects. Our strong customer mix, extensive network, and market positioning enabled us to maintain stable capacity utilization at 82%. We are honored to have received several prestigious recognition this quarter, reinforcing our leadership in logistics and commitment to excellence. TCI Express was awarded the CII Scale Award 24 for Supply Chain and Logistics Excellence from CII Institute of Logistics, highlighting our technological advancement and operational strength. We are also featured in Forbes India's Select 200 Companies with Global Business Potential, DGEMS 2024, recognizing our strategic growth and positioning. Our corporate social responsibility initiatives were acknowledged with the Indian CSR Award 24 by the brand honchos, and we are proud to have again achieved the Great Place to Work 25-26 certification for the fifth consecutive year, underscoring our commitment to fostering a positive and employee-friendly work culture. Looking ahead, we remain optimistic about the anticipated recovery in economic activity, supported by government infrastructure investments, fiscal measures, and a renewed focus on manufacturing growth. The Union Budget 25-26 introduced key measures to strengthen logistics. A new social sector scheme for gig workers would enhance job security, attracting skilled talent and improving service quality. Access to the PM Gati Shakti database will optimize route planning, reduce transit times, and lower operational costs. Air cargo infrastructure upgrades will enhance express delivery efficiency, reducing lead times. These initiatives would provide a strong foundation for TCI Express to drive growth, innovation, and operational excellence. With this, I hand over the call to Mr. Mukti, who will take you through our financial performance for the quarter.
Thanks, sir. So Now I am just going through with the like our presentation for the like 3 month quarter, this quarter and 9 month consolidated. So I will be quickly run that. So can you guys go on a slide, please? Next slide. Yeah, so this is our like key features. This is almost 9 year. We are near to complete of 9 year after demerger, and our service is like 97% is B2B and 3% is B2C. And we have the like 60,000 service locations. We have the 970 plus branches, 3,000 plus workforce. Next, please. These are the like our USP which we carrying since consistently we carrying since last 2 decades, like assess light business model. We carrying high value cargo. We need really working hard on low working capital requirements. Lowest we have the lowest cost structure, and we also like expanding on a similar kind of services in express logistics. We all have our own branches. Then we have the like containerized movement 100%. Next, please. These are fundamentally, we offering 6 major services, which is surface, air, domestic, and international, C2C, rail, and cold chain pharma express. These are the services we offering. These are footprint and across India where we operating 970 branches, 280 sorting centers. Yeah. Next. These are 2 sorting center we already like automated, Gurgaon and then followed by the Pune. Next would be, we will be, I think, in an, end of next year or maybe like first quarter of FY'27, we will be implement the automation in Ahmedabad and Kolkata. We already finalized the contractor and soon will be start in before the one March end. We will be start the construction in those 2 facilities. These are surface USP where we have, as mentioned, is 60,000 pickup delivery location and 50,000 is the pickup locations. And these are our, strength here. Next, please. Air Express is, USP of that we delivering in a measure 24 to 48 hours. Across India, we delivering, we covering 72 plus air gateways. And we also delivering in tier 2, tier 3 cities with the time span of 48 to 72 hours. Next, please. These are the like international air express where we're delivering across the world, and we're delivering through. We almost have the 3,000 pickup point for international business. It is also growing very well, and it has a very positive moment from the. We also doing import from the other countries to deliver in India, so we're doing the two-way. We sending the material from India to abroad and from abroad to India we delivering. Next, please. Rail Express, as we keeping very high attraction from the customer, is growing very well. And now we almost have the 150%, 150 routes and 5,000 customer base. This is also increasing. Now we seeing continuously frequency of the customer. We getting the like repetitive order from that, though as a next segment, but growing very fast. C2C again, as we mentioned in earlier call, so it is a growing sector, is a niche segment. Majorly this used by like auto industries where we clubbing like we picking from the one location, delivering 2, 3 location at destination, and vice versa. Also like picking from the 2 location, delivering on a one location. So these kind of service we giving and adding the new customer here. Next, please. Yeah, cold chain pharma. We again, as mentioned, we only focusing on pharma deliveries. So this is also running, but not on a like good speed. This is running in a normal way. Yes, please. These are the Q3 highlights where we achieved a revenue of almost 300 crore rupees with a EBITDA of 333 crore rupees, which is at 11% margin, and profit after this is 21 crore rupees. We, as mentioned, 3 rupees, we announced the dividend of second interim dividend of 3 rupees. So put together is a 6 rupees now. Yes. We can skip that already discussed. So, we seen clearly this visible in this industry. There is a 2 aspect. One in revenue side where few sectors still not improved. Like one is lifestyle product, second is engineering goods, and some other sectors also not improved. Second part, every like logistic service provider is facing challenge on cost side where and cost has increased for the drivers, toll tax, and we also facing one more challenge is to be increase the air cost also due to like duopoly of these service provider, and second is privatization of these airports. So these are the two things where we face the challenge on revenue side because volumes are low. Other side, cost pressure is also coming. So these two things clearly visible in overall industry purposes. Yeah. These are the like quarterly results, 3 quarter, what our performance is. Yes, next, please. This is a 9 month where we seen a growth of 900 crore plus. There is a decline in revenue is almost 3.5%. And at EBITDA and PAT level is around almost 27%. This is a highlight for the 9 month. So again, capacity utilization in our truck as seen is overall in 9 month is around 82%. And we obviously have the two sorting center. Cash flow operation is 40 crore rupees. Total dividend we are given like 6 rupees. Revenue mix slightly changed in 9 month. It is 51 big customer and 49 is SME. In Q3 is also like slightly different. It is almost like 53% big customer, 47% is SME customer. That's why one of reason to decline in our margin levels. So cash profit is you seen is a decline of only 25%, and that has been reduced from 114 crore to 86 crore rupees. Yes, please. These are the again 9 month performance we have given for the comparison of last 4 years. Please. Key ratios, if you notice, like return on capital employed slightly declined because there wasn't a reason because we margins are slightly down and initially capex is growing fast. So I think in one initial or of 2 to 5 year we have to be face like slightly moderate kind of return on capital employed. Once we finish with the like capex, then we will be again start to enhance and have the planning to be go back to in the range of 35% plus. Cash conversion ratio is again strong. There is no challenge on that. It will be like in the range of 70%. Please. Yeah. So again, I just discussed. We can skip. Leverage profile is robust. So again, if you see payable days are 35 days, receivable days is 58. So net working capital requirement is in the range of 22 days. So for the running or our daily show, we really not need any kind of funding, and this is a self-sustainable and a system. Yeah. In spite of all the challenges, we still highest PAT margin in the industry, which you can see in like out of these 6 industry players, we are the highest one. And second player peer is also like our group company TCI. Yeah. We can skip that. We already discussed in last. Strategy and outlook is very clear. We will be, diversified on the both way, customers as well as supplier side. We will be keep continuing expanding branch network. This time we slightly, slow down that because, we opening up the branches to cater SME customer majorly. We see in a like slowdown in a SME customer, so we pause that one for the time being. And though we are opening up like 1 or 2 branch in a month, but not like aggressively going on. Once we will be seeing the volume back from the SMEs, then we will be aggressively expand on a branch network side. Capex side, yes, it is also as per expectations, but in this year, I think it will be slightly low, but next year we have very clear visibility for the capex of around 110 crore rupees. Yeah. This is our priorities. So we will be keep continue to growing in the other markets. Sustainability side, yes, we will be ESG. We will be focusing on that, and we will put like basically to put EV vehicle for the last mile, first mile deliveries, or wherever is possible to put into in mid mile. We will be give that. We will also like putting hard wherever we put building up new era sorting centers. We giving as a solar for the electricity generation. So we will be keep going on to putting our pressure to be these ESG initiatives. Technology, yes, is a backbone. So we also putting more and more digitalization in every function in company. Yeah, please. We can skip that. We can skip that. So these again a long-term perspective, the logistic industries growth drivers. Yeah, we can skip that. This is a management team. Please, next. So, this is clearly visible, these things. Transportation cost has increased, margin has been declining in this particular time. Manufacturing activities is surprisingly in a good month where we anticipated a good month that has been, declining, and lower consumption, economic, I can't say slowdown, but it's a like a muted one. And customer confidence index has also like slightly, reduced. So these are the things which is really clearly visible in overall way. Yeah. Yeah, next, please. Yeah, next, please. Next. These are the award recognition, as you already discussed with that. Yeah, next, please. So thank you very much. We can be take the question and answer on that. We are happy to answer.
So participants, we are going to open the floor for question and answers. Please raise your hands to ask your questions. So we'll begin the question and answer with Mr. Devra. Mr. Devra, you can go ahead with your question.
Yeah, hi, I'm audible.
Yes, you are.
Yeah. Sir, very good evening. Just had a couple of questions. First, if you could just indicate what has been the volume growth for this quarter, or rather, or degrowth, I think.
Yeah, so volume is Alok, volume is reduced by almost 3% in this quarter.
Okay, okay, okay. So, sir, I just wanted to understand. I mean, the growth has been pretty muted through many quarters now. So even this has impacted the margins also quite significantly. It's come down by nearly, if we see YOY, it's down nearly 500 basis points, and even QOQ, it is down by nearly, 200 plus basis points. So how are we seeing this market now? Because you have been mentioning about even in the earlier call that how other players are taking price hike is not known, and market is very tough. So how do we see the fourth quarter also shaping up now? Because I think this volume growth, even in January, I don't think there would have been much improvement. So would this volume run rate of Q3 continue through Q4? And would this margin also, which has come down to almost like single digit now, would this be in this tight range?
Yeah, so very well. So, there's a two type of things is happening simultaneously. Like one is, volumes are down. There's a very clearly visible across the industry. We are like hit because SME is first time getting hit, and that's why it is volumes are down for that. And that's why it is also hampering our margin because as you aware, this prices from the SMEs is higher than my contract customer. So that's the one of reason. Second reason, that has never happened where volume declining and cost pressure is also simultaneously there. But in this year, this is a different situation where we facing the challenges and also muted volumes. Second, cost pressure, which is visible across the industry, which is as I mentioned, is contributed by increase in toll tax, increase by driver shortages, increase by labor cost, and in our case is like added by fuel also by air cost. So these things is really, but and ultimately by lower volume, our utilization of truck is reduced. So by these, you see in a two way. Once we will be like bounce back with the volumes, once is a normalize the situation, which is really very hard to comment on Q4 because once we like in a last quarter we seen the quarter October month was slightly okay, and then we seen November and December month is again always the best month, but we've not seen that kind of even degrowth on that month. That was one of region also where e-way bill site has closed on a last day, so that is also impacted by my value, my volume in this quarter at least 1.5 to 2% on that day particular day. So these kind of thing is happening. So I'm not seeing any much difference, but it's really very hard to comment on that. So this is the one volume side. Second, cost side, I think this will be continue because we discussing with the customer. So our case, if you see earlier, we were the first one to take the price hike from the customer because 50% is the SME customer. But this time, SME customer is already facing the challenges due to high inflation, high interest costs. They are not able to support us on this time because again, volumes are very less and they also have the like impact of muted growth. So we, like now touching the like all big customers, so they also assuring us to be giving the price hikes. So gradually we getting that in this quarter also we getting a benefit of like getting a price impact of 25 to 30 basis point. But from January onwards, we getting good price hikes from the customer. So both things will be like improve in this quarter, and next year I think hopefully we will be seeing the situation is improved a lot.
Sure. Sir, have the competitors, couple of them had given I mean, it's public information like Blue Dart and Gati had mentioned about a price hike from January onwards, and VRL has already taken a price hike at the end of first quarter. Have these price hikes gone into the system? In VRL's case, it is much visible that it has already shown in the margin profile. But what about your other competitors like Gati, Blue Dart, and others from the unlisted side? Has the competition taken price increase? Because we have not taken price increase and still the volumes have not come by. So just some clarity on that, if you can provide, it would be helpful.
That is, I think you whatever name you taken for the competition, they also not growing in volumes. Either they growing through the price hikes, like as other competition said, we taken so much price, and that growth was also equal to that. So this means volumes are not there. Price may be due for them because good thing was with us, we consistently taken the price hike in over the period of 4 5 years, and that's why our margin has jumped from 8% to 16%. That was sustainable. But this year is a like slightly unique position where SMEs hit, and we always like taking the price hike from them, so they are not able to increase. But I am not see other customer in express, pure express, they will be able to take the price hikes because again, this segment where we dealing with these segments, especially lifestyle, engineering companies and electronics companies, they will be allowed to increase the prices in this tough time. So I am really not confident about to be like increase the prices by these all, competition.
Sure. Just last question. We generally maintain that we will grow at 1.5x of the GDP, and do we maintain that, or is it something that it's not in sync at this point for the entire sector, not just for the company, where the growth in the GDP is not really reflecting in the growth in the road logistics sector, which could definitely impact us as well. So just that would be my last question. From a longer term perspective, like 2 years, how do we see the growth?
Yeah, well, so this year, this is clearly visible. You see, like FTL industry slightly grow because that government capex happened, and that's why I think they have the slight growth on that. But they also have the very high pressure on margins. Every FTL company. Second part, you this is the like exceptional year in this, which is we stick with that 1.5 kind of X growth for the GDP. This year, more GDP is coming from service and less from the manufacturing. So we will be stick with that 1.5x of real GDP growth. And this is, I think, one exceptional year we see.
Awesome. That's all from my side. Thank you and all the best, sir.
Thank you, Alok.
Our next question is going to be from Nimagada. Mr. Nimagada, please go ahead with the question.
Yeah, hi sir. Thanks for the opportunity. Couple of questions from my end. Firstly, sir, you spoke about some improvement on the pricing from Jan. How is the volume trend like? Do you see any kind of recovery out here? Also, if you can provide the absolute volume number in the quarter, please.
In this, very well. So in this quarter, we achieve a volume of 2.42. You're talking about quarter or this month?
This quarter, sir, in the month in 3Q.
Yeah, Q3 we have achieved a volume of 2,42,000, 2.42 lakhs ton, we have taken in a volume in Q3.
Okay. Okay. And how is Jan been, sir? Because you spoke of price hikes, and because some of your peers are speaking about price hikes, so therefore you should be able to garner that kind of market share, right? So I'm just trying to understand how the volume growth has been or degrowth. What is the scenario like in Jan?
Honestly speaking, this January is fantastic, or you can say that they started a growth. But again, we are also worrisome because all the time we seen in last 3 quarter where good month is not performing well. So we depending upon the March, how March month is playing. So we are taken a growth in January, but we are really not sure. Very hard to comment on March how they playing it. So same way like in Q3, we were in a good note on a start with the October, but finally December month was, I think you can say is a worst perform. So this
Mm-hmm.
sense is really hard to say, but yes, we always keeping trying to be hard to get the volume growth back to normal.
Okay. So what was the price hike that you took in Jan? You spoke about decent amount of price hike. So anything that you would like to quantify approximately?
Sorry, come again. I just missed your
Uh,
last.
Sir, I was asking what is the kind of price hike that you took in Jan? You were speaking about that you saw some decent price hikes in the month of Jan. So any quantum that you would like to indicate?
So again, SMEs, we are not pressuring to for price hikes because again, there is
Mm-hmm.
still they are in a slowdown or muted growth. We
Mm-hmm.
now targeting our big customers. So hopefully, I think we will be in this whole quarter, we will be able to take the 1% price hikes overall basis because 50% is out. Then
Mm-hmm.
remaining 50%, supposing we get from the only 30% plus 30% customer. So
Mm-hmm.
ultimately, it will be converted into an almost 100 basis point.
Sure, sir. So my second question is on the investments that the board has approved for on the Singapore side, the $7.5 million. I mean, this is roughly about 35-40% of your cash balance. So I'm just trying to understand what was the rationale behind this investment and why is the company looking to do it, and the current scenario when the domestic market there are challenges where you still have to cut down on the capex. So what was the thought process here? If you can help us understand this, please.
Well, so this new capital requirement is for not this year. It is for like 25, 26 and 26, 27 for the
Right.
2 year. So overall cash flow will not be more than like 10 in the range of 10 to 15% in each year. Second,
Mm-hmm.
our rationale to establish that company to be having like freight forwarding business in across world to Singapore and inbound and outbound. That will be also help us to be support an Indian business where we can be import the things in India and then can distribute across India as in from the express model. So we want to be establish operation in Singapore, but in a gradual way. So that's way we will be putting it.
Uh, okay, sir. I mean the reason I asked you that question is also in the context of the weakness that we are seeing in the domestic market and where we also had to curtail the capex. So it's somehow it feels that I mean what you're doing perhaps is right. Just trying to fit it in the context. I mean why you are when at the time when you had to cut down on domestic capex, you're looking at international investment. So that part I was trying to figure out.
No, so basically we are not curtailed any capex because our capex, why I'm saying our capex is completely depending on the, buying of the lands. So we not curtailed any, capex. Whatever capex we doing that. Now we already finalized as a contractor because after buying a land, we taking almost 1.5 year to be clearance and everything to finalize everything. So now construction will be start in this quarter only. And as I said, in Ahmedabad and Kolkata in a big way, and both facility put together would be around 5 lakh square feet. So next year these will be ready by March end, or automation will be maximum again March end or max first quarter of next year. So everything is planned and is not on cost of domestic capex to international investment. This is a separate thing. There's a separate strategy for that.
Okay. So just
Yeah.
to understand, does your sister company TCI have any presence in Singapore or you don't have any presence over there?
No, they don't have any presence in Singapore.
Got it, sir. Thank you very much for your
Yeah.
patient answers. Thank you.
Thank you, please.
Our next question is from Mr. Krupa Shankar. Please go ahead with the question.
Yeah, good evening and thank you for the opportunity. So, sir, my first question would be slightly more on your contribution from SME as well as the large corporates. One of the reasons why we had a higher preference for SMEs was our margin profile, but really the operating efficiencies, has been lagging because the volume also has not been contributing to our or to overall system. So are we re-looking at adding more corporate customers and changing the mix because that can be one lever wherein which can drive your overall operating efficiency. Any thoughts around that?
Absolutely right. You rightly said. So what we also strategizing, because specifically if you see on an eastern part of India, there is an SME eastern part of India or other part like down south and all, there is a no manufacturing and we completely depending on SME customers. So this is a dual challenge for us from the eastern part and these part of India where we have the SME presence. They have less volumes. So our returning load is reduced. That's why my utilization level is 82% right now. So we also like exactly, more focusing on a big customer there wherever we have, and we really getting good response on that side. So aggressively we pushing to be more focus on a big customer rather than SMEs. Once this will be normalized, then we will be again take this ratio like 50-50. So absolutely right, we're doing on a strategy on that way only.
Got it, sir. So second part is on primarily on while I do appreciate that MSMEs are not are facing a lot of challenges here. You are supporting the trade at this point by not increasing price hikes or not taking price hikes rather. Um, just wanted to get a sense, see, because we are in a hyperinflationary environment, if I were to put it, across all cost heads, and tonnage is weaker. So why the hesitation in passing the increase in costs? Sir? It's not that we are profiting higher just because of, and that's one of the reasons why we are taking a price hike, right? So we're just offsetting the cost which is there. So just want to get your thoughts as an industry itself. Why is it that there is a fair bit of hesitation to take price hikes at this point?
Yeah, well, so these are the SME customers which helped a lot us all the time. They support us. Now really they need a support from our side. We have the like informal relation with them. We have the long standing relationship of like more than 1 decades. So we listening them carefully. They helped all the time. So this time or also if you see cost is also manageable. Wherever we did our cost has just increased by 200 basis point, which will be normalized once volume will be like back to normal. So there is I don't think so very any worrisome. They will be also support once they will be normalized on their business part. So we really not seen any problem there, and we unnecessarily don't want to be put there more pressure to enhance our profits basically. So this is a like give and take in a business basically.
Understood. Understood.
Yeah.
Lastly, if I may, while you have highlighted that the branch addition is going to be not as aggressive as previously anticipated until traction and growth is visible. Any thoughts around what would be the potential branch addition in FY 26-27, given that you're adding a lot of capex towards constructing new hubs, especially in Ahmedabad and Kolkata, and also you had constructed two hubs in Gurgaon and Pune. So just getting a sense of any plans around FY 26-27 on branch addition.
Yes, as well. So basically, we opening up the branch to support SME customers because for the big to cater big customer, we really don't need the much branch network. So that's
Right.
why now SMEs are really in a slightly muted growth. So we decided just like in a go slow on that, not the stop. So next year again, we will be have the planning to open a branch in the range of 50 to 75, and in 26-27 again in the range of 75 to 100. That we will be surely we will be open that branches more focus, like we have the strategy to be open almost 30 to 40% branches to support the multimodal business, remaining for the surface business. So
Got it.
this strategy we will be go there.
Okay, sir. Right.
Yeah.
Last question, if I may, sir, is are you open to sharing data relating to contribution of new services like the rail and cool chain and etc.
So all put together, services is still stagnant at the 17.5 to 17 to 18%, and remaining is surface.
Got it. Thank you, sir.
Another one aspect also would like to mention here earlier, we have the e-commerce share in overall revenue is 4%. Now it is also shrink to 2.5 to 3% only, because as you are aware, our focus is not on a B2C. So now few customer asking again cost, price reduction, and also we are not going into these things. So our B2C share is also shrink to 2.5 to 3% from 4% in last year. So that's also one of reason to be reduce this volume in this side.
Got it.
Yeah.
Thank you, sir. That's it from my side. And all the best.
Participants, to ask questions, please raise your hands. Our next question is from Mr. Rohit. You can go ahead with the question. Mr. Rohit, you can go ahead with the question.
Am I audible now?
Yes, you are.
Yeah. Hi, sir. Just one question from my side. Of the total revenues, how much will be the retail portion that we have right now?
Right now, so Rohit, right now in 9 months, it is ratio is 51 big customer, 49 small customer. But in particular, this Q3 quarter, it is 53 47.
Sir, I'm speaking about the retail. So maybe the lifestyle that you said, lifestyle segment.
Oh,
How
okay.
much?
Okay, you
Yeah.
mentioned that. Yeah, retail.
Yeah.
So retail is overall basis is almost around 9% to overall revenue to us.
9%.
Yeah.
Okay. So
Yeah.
that's it from my side. Thank you.
Yeah.
Next question is from Kaustubh. Please go ahead with the question.
Yeah, hi. Thanks for taking my question. So, wanted to understand from you, how will this gradual move from road to rail, the implementation slowly of the DFCs, financially impact and operationally impact our services business over the long run?
Yeah, well, so because rail is not in a really competition with the road, whatever they're building up this freight corridor, this is meant for to be carrying commodities and exim cargo. So they building it for that, because for the road it is really can't be multi-mode for that. FTL is as you are aware, these are direct from factory to factory. Our business also door to door, so rail can't be covering that. But tomorrow, supposing this is really viable and economically viable to be have the mid mile through that, is a faster or connections and service loading unloading at platform is really fantastic, then we can be think over to shift our mid mile. This is very good for the overall industry. So then we will be think on that.
And yeah, but then this Rail Express vertical of yours, what is the exact purpose from which you started that, and what are you trying to achieve by blending? I'm assuming you're blending Surface Express and Rail Express.
There are two different products. Surface, usually the transit time is 5 to 7 days, and rail is 2 to 3 days. So that's the difference in the service offering. The pricing is higher for rail because it's a faster delivery service. Therefore, there is no overlap between rail and road in the express business for us.
And rail also, to mention here, rail is through passenger trains. We are not utilizing this goods train.
Yeah, that's what I was asking. Could you explain the business model of your Rail Express business? That was my question.
Yeah, it is again, it's a substitute of air services, where they're giving whatever prices, and we doing these rail services and one 25% cost, and with the same kind of TAT, where we putting our material into in passenger train and then delivering. So it is also door to door service, and we giving on a similar kind of TAT, which we deliver even competition in air mode with the highest price of 4x. So this is the model we have. That's why my Rail Express is moving very fast.
Okay, understood. When you say door to door, you mean then a truck collects the product from somewhere and then delivers it to the customer.
Exactly. It's a multimodal basically where we
It's a
pick from the customer's premise, bring to like a platform, put into in train, passenger train, and then collect from destination location and deliver to customer's destination, customer's place. So the whole value chain we are giving to them.
Understood.
Yeah.
Okay, great. Thank you. Thank you.
Our next question is from Mr. Ravi. Please go ahead with the question. Mr. Ravi, you can go ahead with your question.
Hello, hello, hello.
Yes,
Are you
Ravi.
listening me?
Yes, Ravi,
Are
you
you
are. Yes.
okay? I am shareholder since last 10 years. And what commentary, Chandar, you said before 2 to 3 years, now business is different. What you said earlier, I visited Gurgaon Shooting Center too. Had you any idea such bad time come to lifeline of country business? And if it comes, when it will be a normal one?
So nice to speak to you again. This year is election year, and last year, sorry, what I mean. So the whole of the financial year, there have been elections. So we saw the poor situation of the economy because cash had dried up from September of 2023, since the 2000 rupee was banned. We saw the economic downturn started happening. Coupled with that was the high interest rate and the inflation rate. So everything is now subsiding. Elections are over. Hopefully now there will be a rate cut. And of course, let us not forget that the global challenges of the three wars that were happening. So all that also came into factor where we started getting affected. The economy or the country started getting affected. You see, the situation was so bad that to win the power, nothing was being cared about for the businesses or the country. Now, that is aside, we have already started seeing growth in from January onwards. So going forward, we are well poised, well positioned to handle the growth which will be coming on. Now, let us not forget that we have been paying dividends very tactfully, and also at the same time, we have been profitable also to the extent that we have not taken a loan till now. So looking at that, I mean, a glitch like this is okay. We are able to manage it and sustain it and go forward.
And also to add that, Mr. Ravi, basically we seen these kind of cycle in 2008-9. That time global slowdown was there, and we seen this kind of problem again in 14-15 before, just like before GST time. That time has been run through by like 1.5 year, and then again whole industries come with the next leap of the growth. In that. So we hope also like now worst time has gone, tough time has gone, and we will be start to moving in a positive side.
Thank you very much for
Yeah,
your
please.
reply. Okay.
Yeah, thank you.
Our next question is from Mr. Jinesh.
Am I audible?
Yes, you are.
Yeah. Thanks for the opportunity. Sir, my question is on our volume growth trajectory. Now, I think if I remember right, in the last call, you had mentioned that our target for FY'26 is approximately 13 to 15% in terms of volume growth. But given how the performance has been so far, um, uh, especially on the SME side, where you mentioned that there is a which they're going through. So essentially, how should we look at the next year in terms of volumes? And also, if you can call out any specific sectors that are witnessing more challenges within the universe that you operate. I think you mentioned that retail is at about 9%, but any specific sector which is having a major impact as far as your volume uptick is concerned?
Yeah, so you rightly said. So, we've taken a target to be grow in the range of value wise in the range of 12 to 15%. Volume, we will be grow like a double digit at least 10 to 12%. So we also intend to be take the price hikes in next year also. So one of that. Second part, you rightly said. So we now think why should we so depend on the SMEs because this is not doing well. So we more aggressively, taking the going for the big customers, and we also achieve that result in this January month. So we will be go with that strategy. Third thing, we also like very aggressive to be for the multimodal businesses, wherein rail and air are our forefront for that. So we're putting high, effort for that as well. So margin will be, we maybe like margin is already like erode on a 300 basis points. So we not seen any further erosion on that. This is like sustainable margin, whatever we did that. So I have seen there is a growth aspiration for the next FY'26 we will be achieved in time to come. Yeah.
Sure. And sir, I'm a bit new to the industry, so this question might sound a bit basic or silly in nature, but
Yeah,
just
no worry.
wanted to understand the overall universe. I mean, given the challenges that we are facing, how are the other competitors doing? I mean, are we holding on to our volume market share when we say that we are at about 2,42,000 tons? So are we holding on to our volume market share, or are we seeing volumes shift across the competitors? And what is the overall universe in terms of total volumes, and what kind of growth or rather degrowth one has witnessed in that universe, say in the last couple of years? And how do you see the overall demand scenario shape up for the next year?
Yeah, well, so if you see other industry player where FTL and LTL, they slightly in a growth because this market is very fragmented and they can be get the FTL movement from the unorganized player very well, very easily, but must be compromised on a margin level. But if you see the express industry is working in a different way where we catering to B2B customer. Our challenge, we can't be compromised on a service level. FTL industry, LTL industry can be compromised on a service level because we are as a premium service provider. We can't be compromised on a service level. This is one aspect where we once we volume will be back, then we will be normalize our margin level. Second, new industry we also targeting like new bathware, kitchenware, home furnishing. These are the new industry where people like buying, and we giving and we also putting very high emphasis on that to be adding these customers. So we're doing that. Third, we also changing slightly our aggressive strategy to be focusing more big customer than SME customer, because SMEs, I think that will be maybe go like in again for the 3 or 6 months, maybe have the pen depending upon the how like RBI maybe cut on the rate or inflation plays, and so this all depending on the various thing, but we clearly intend to be keep ready for the FY'26 to achieve like 10 to 12% in a volume growth.
Sure, sir. Okay. Thank you so much.
So we can have more 1 or 2 questions, then we will need to close that.
Okay, our next question is from Miss Achal. Please go ahead with the question.
Yeah, good evening, team. Thank you for the opportunity. So just two questions first. Did I hear you right in terms of your multimodal revenue mix is about 17-18%?
Yes, correct.
And what kind of contribution are we looking at over next 2 years or 3 years?
So we planning to be have 22% at least in the next 3 years. After 3 years means. So each year we want to be enhanced with the growth of like faster growth in multimodal means, because these are a very niche segment in air and rail. So we want to be enhanced at least 1.5% each year. So by after completing 3 years, we want to be that share in 22%.
And that comes at superior margin to current level or similar level of margin?
So these slightly superior margin in air and rail express.
Understood. And when you're looking at a double-digit volume growth, which are the 2 or 3 sectors you think will drive that growth? And secondly, as you said, you obviously going to focus a bit more on the corporate side, which will be at a lower margin. So what's the typical margin difference between the two in terms of between corporate and the SME?
No, so basically it will not impact my margin, rather it will be improved, because now is a matter is to fill factor of my truck has to be improved on those routes where we really have the low volumes. So it's really help to improve the margin, even not reduce the margin. And this ratio is also not bigger one, like we just looking for the 2% or 3% kind of change in that ratio. So ultimately it will be again, we all said all the time saying, big customer giving the volumes and small customer giving the prices. So this time we really need the volume. So that's why we catering that. And once normal time will become, then we will be more aggressive to get the business from this SMEs and get correct this ratio again in the range of like again 50% SME, 50% big customer. So that's a strategy we want to be adopt, specifically on a return loads where we have the like emptiness in the truck. So we want to be fill up, because as I said, we can't be compromised at all on a service level. This is the fortunately, unfortunately, in good time is a good thing where we have the higher volume and good margin. But in like this low time, we have to face the challenges of like vacancy, and it is a like direct cost to us. Tomorrow, supposing my volume increase, that completely will be very fast. It will be improve my margin level of 200 basis point once fill factor improve by 2%. So this is directly linked with the service levels and volumes.
So in a sense, if I understand right, essentially what is happening is that because of the weak volumes, there is an underutilization of the fleet. So fill factor is lower.
Yes.
Is it some sense in terms of how it is trended in 1Q, 2Q, and 3Q? Has it gone down materially? Has it remained stable?
So it's almost, we achieve in a one quarter where we highest volume is around 84.5%. In this year, we achieved 82%. So volume, this vacancy level is around, this reduced by almost 2%.
Okay. And is it any particular leg, sector, region it is acute, and which even though the overall number may not look that low, it has a disproportionate impact on the margins?
So slightly decrease, as I said, SMEs is slightly weaker. So we getting impacted through like eastern side, from eastern to across India, and down south to across India. These two sector where we depending on majorly on SMEs, that's impacted.
Understood. That's very, thank you, and wish you all the best.
Thank you, please.
Our last question is from Vikas. Mr. Vikas, go ahead with the question.
Good evening. So my question is, as we are planning some international services, already we are having, but offices in international locations like Singapore, what can we expect in next 3 to 5 year span contribution from international services, and especially the network? How many countries we will be doing, which type of services, LCL, FCL, or only air cargo? And second question is on the automation. We have done 2 hubs automation. Finally, now all the teething, these problems must be over. What's the impact of this automation on OPEX and operational efficiency?
Yeah, because so basically international side is really very hard to say on the numbers. We are not diverse. We can answer on a one-to-one basis, but basic idea, because we already have the network across India through agent network. So we don't have any further office opening in worldwide. We will be keep the office in Singapore only, but we do the work. We will want to be a hub there, so we can do from the Singapore in and out. Second part on automation side, we, as already mentioned, there is an efficiency improvement a lot in these two center where we reduce our turn, this time to be process the cargo in these two two settings, sorting centers. So ultimately, we reduce the cost by like 30 to 50 basis point put together in these two centers in overall basis. So we will be keep adding the sorting automation in the new center wherever we building up. Like as mentioned, Kolkata and Ahmedabad will be the next one, followed by Chennai and Mumbai. So we will be going in by data strategies.
Thank you.
Yeah, thank you.
So with this, we end our question and answer session. Mr. Muktilal, would you like to have ending statements?
Yes, Mr. Chandra will be given.
So I must thank everyone for participating the TCI Express Concall for Q3 financial year 25. To summarize, despite the evolving macroeconomic landscape and sectoral challenges, TCI Express has continued to demonstrate resilience, adaptability, and strong commitment to operational excellence. As we move forward, we remain optimistic about the long-term potential of the logistics sector and the express industry, supported by favorable policy initiatives, infrastructure development, and growing demand for express transportation solutions. We are confident that our asset-light model, disciplined financial management, and customer-centric approach will continue to drive value for our stakeholders. And with that, I must thank you.
Thank you, please.
Yeah, I would like to thank management once again for providing us the opportunity to host this call. On the behalf of ICICI Securities, that conclude this conference. Thank you for joining us, and you may now disconnect your line.
Thanks a lot, please.